Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh.
Welcome to Wealth Matters podcast. I am going to talk to Mr. Wesley Sierk today. He's the President and Lead Strategist at Risk Management Advisors Inc. And he's an expert in the implementation, design, and management of captive insurance. And I have heard a lot about captive insurance, not only from my own journey, but when I was starting, I had heard about it on different podcasts, as well as read about it somewhere as well on different blogs. So I want to explore this area a lot today because I want to see how I can save taxes. Plus, I can have asset protection. So Wesley has almost 20 years of experience in the field. So he's very, very experienced and he has unique insights into the world of captive insurance, asset protection, and risk management. Welcome, Wesley.
Thank you. Glad to be here. I'm excited.
Absolutely. No, I am looking forward to this episode. So thank you so much for your time. Tell us something interesting or funny about yourself.
Well, I'm in the insurance business, but what I always wanted to do growing up is be an opera singer. That's all I ever wanted to do. And then I hurt my vocal cords, and then I had to pivot when I was 16 and find something else to do. Little known fact.
That's awesome. So which assets do you invest in and why right now?
I have a fair amount of crypto.
Okay.
But that's money that you can afford to lose because of the volatility. I have a diversified portfolio of stocks, 2 investment properties, and a lot of my, not to get off track, but a lot of my assets are in 3 ETFs.
Oh, really? Okay.
And they're 3 ETFs that I started in December 27th of 2019 and started it with $80 million of some of my money, but other RIAs that I knew. And I'm not an investment guy. We just were fortunate enough to sell our business. And I wanted to figure out how can I make sure that I had this money for the rest of my life? Because this was my money. So right now it just crossed. So in 20 months, it's gone from 80 million to 580 million.
Wow.
So yeah.
Last 2 years have been crazy for stocks to real estate to cryptos. Everything is like 1,000% up. So that actually worries me right now because everything is frothy. What do you see now? Because stocks, of course, you can tell now, but cryptos, real estate, it's just crazy, ridiculous, right?
Yeah, everything's overvalued. I mean,
yes.
Home prices are overvalued. You can still find stuff. We just closed on a house last Friday in Paso Robles. But that was one where it was a good deal. So that was the right place, right time, and got it. But for a lot of stuff is overvalued.
Yes.
A lot of stocks are overvalued. The reason why, I like my ETFs is because based on the construction, when the market starts going down and new money goes into a money market. So if, let's say it's S&P, if the S&P starts going down, so new money in the S&P goes below 40% and money into the money market goes above 50, it automatically rebalances and goes to cash.
Oh,
so
okay.
I like to call it alpha, and some are value, some are global, some are US, but I like to call it, and it was my friend Howard Getson that came up with this term, but it's really alpha through avoidance. So when the market goes down, you're out of the market. And when it goes up, you're in the market. So that's really why I came up with those.
Oh, that's awesome.
I'm a long-term buy and hold kind of person.
Yeah, me too. Means I have a trading account where I trade very little, but the whole idea is, buy and hold long-term. Because people always say, oh, buy low, sell high, but you can never time the market, right? And I'm yet to see a real trader, who is a multi-millionaire or a billionaire. Even Warren Buffett, buys and holds, right? Of course, he buys it at the right price, but in the end, he's not selling every week or every month.
Yeah. Even guys like Ray Dalio.
Yes.
Yeah. It's buy, it's not buy and sell, it's buy and buy and buy and buy.
Yes.
It's just buy good companies that you believe in and you use, and
dollar cost averaging, right? Buy when you up to the price point you really want to get. Oh, this is great. So let's talk about captive insurance. What exactly is that?
A captive is it's a licensed regulated insurance company, but it's the business owner or the commercial property. If you have a big portfolio of commercial property, instead of paying AIG, Zurich, Liberty, you actually create your own insurance company and you pay those premiums to your own company.
Oh.
And so those are deductible. And then to protect the downside, you go out and get reinsurance, which is insurance for insurance companies. So you can determine how much risk you want to take. And insurance companies are given special tax benefits. It's not a tax strategy, but insurance companies are given a special tax incentive that other companies don't have. So if you're a small insurance company, and the definition of that is $2.35 million this year in 2021, $2.35 million per year in premiums, then your premium income is tax-free and your underwriting is tax-free in the insurance company. You only pay taxes on your realized investment earnings. So let's say you put it in an ETF. So we have clients that pay, $1 million, $2 million a year to cover their business. Because you have to, so it has to be legitimate insurance and you have to have legitimate risk. But if instead of buying property, casualty, liability, workers' comp, health insurance from the traditional market, you pay, let's call it Wealth Matters insurance.
Yes, I was actually going there. I want to understand this.
So if you have risk in your business, like you have investment property, so you say, I want to cover slip and falls. I mean, we have somebody that does investment properties and they have a tenant deposit insurance. So instead of getting security deposits, the tenants just buy insurance so they don't have to return it. And they have tenant damage waiver policy. So the tenants can actually buy this policy, or they take a percentage of their, rents and put it into that. But
so let me interrupt. So sorry about that. I always thought the captive insurance only applied to businesses, but not rental properties. But now this is opening my eyes that you can actually apply this to your portfolio of rental properties.
Yeah, correct.
That's pretty cool.
So you could create Wealth Matters insurance, and then you take a percentage of the rents you receive and pay that into Wealth Matters insurance. And the good thing is let's say no one moved out, there was no damage, there wasn't a fire, there wasn't a flood, there was nothing. Then that, you pay $1 million, that $1 million is inside your insurance company.
Right.
And in other businesses, that would be considered profit. Even if you wanted to leave it in that business, the IRS says that's fine, you still have to pay taxes on. But because it's an insurance company, that $1 million in underwriting profit, you're not taxed on. So let's say you put the $1 million in a CD that gave you 1%, just to keep it easy.
Right.
And you would have made $10,000.
Right.
You would pay a 21% federal C Corp rate on that. So you would pay $2,100 in federal taxes and no state taxes, because insurance companies don't pay state taxes. They pay premium taxes to the jurisdiction.
Oh, okay. So even if it is in California, you don't pay any state taxes.
Correct. Because insurance companies pay state premium taxes on their premium income that they make.
Okay. But in this case, the insurance company will not pay any premium tax either, because you said that up to 2.35 million, or they have to pay state premium tax.
The premium tax is a regulatory thing. So it depends on the jurisdiction you go, but it's going to be anywhere between $3,500 and $5,000.
Oh, okay. Okay.
In premium taxes.
Got it. And you mentioned C corporation. So again, I'm just going to take my own example that we have Wealth Matters, which is an LLC, but I also have a C corporation as well as an IT consulting business, and we pay for our own insurance. Can I create another insurance company? And does it have to be a C corporation?
Yeah. So insurance companies, in order to get the tax treatment we're talking about, they have to be C Corps or LLCs taxed as C Corps, and they have to have a December 31st year end. So those are the two requirements. But the insurance company can insure any entity. So you could be a sole prop, you could be an S Corp, it can insure the LLCs,
Okay.
it could insure your IT consulting business. If that's a C Corp or an S Corp, whatever it is, you can still insure it.
Got it. And can you commingle? Right. So I have a C corporation with a business partner, but I have LLC with another myself. Can I create one Wealth Matters insurance company, and the C corporation also pays me the premium, or the insurance company as well as the LLC pays the premium, or do I have to have separate uh, captive insurance C corporation for each of the entities?
No, that's a good question. Basically, what you would do is think of Wealth Matters Insurance like AIG.
Mm.
So all the different entities you have would pay to that one insurance company you have. So that insurance company would write many different businesses.
Got it.
It would
Okay,
insure.
no, that's even more enticing now. So,
Yeah.
and sorry, I had interrupted you earlier, and you mentioned about the tenant deposit insurance and the tenant damage waiver. Can you elaborate on that so I can have I can ask my tenant, because sometimes we ask tenants to get insurance from outside. So instead, they can get the insurance from my insurance company. And how does the tenant damage waiver work?
Well, they would pay a certain amount of money per month, and if there's damage to it, so it's not like renter's insurance where it's going to cover the stuff inside.
Yes, if
Still
it's
want them to
stolen or
have it,
something.
but
Right.
you would have the ability for them to buy this tenant damage waiver. So in the event that there's damage inside of your that apartment or single family residence or whatever, then that tenant damage waiver would come in and give you the money in order to fix the property that they damage.
I see. So
And then
that's very interesting, because I just went through it in at one of my properties, right? So I ended up spending over 10 grand because the insurance company we were going with, they didn't cover the expense. They said, oh, it was 6 months old claim, that we don't do it, and it was just a pain in the neck. So this is opening my eyes right now.
yeah.
So
And the best part is what you're doing. I mean, the way insurance works is you're paying premiums today. And the reason why they get this tax treatment is you're paying money today for something that could happen tomorrow, next month, 6 months, a year,
after 10
years from now. So in that way, if insurance companies were taxed like every other business, they take in premium dollars, but if they didn't have a claim right then they would have to pay taxes on their profit.
Yeah, because
So
there is
as
no
a result,
expense.
yeah. So they wouldn't have enough money in reserves
I
in order
see.
to cover the claims that come down the road. So that's where you get this special tax treatment.
Now it makes sense, right? Because today's dollar is always more valuable than tomorrow's dollar, right?
Yeah,
With the
correct.
inflation we already see. So if they pay tax right now, they don't have any expense, and they are going to lose value even more, right? Okay, so that makes sense.
And then if you look at the deposit, so let's say you're charging somebody $3,000 a month and they need first month, last month, and then some sort of security deposit. That may not be good. So on your books, if somebody gives you a security deposit, you keep it as a liability on your books because eventually you're going to have to pay it back to them. But they may not have the money to move in because of that security deposit. So let's say the security deposit was going to be $3,000 that they may get back. Most tenants are skeptical that they're going to get their whole 3,000 back, or what percentage of it. But if you gave them a choice to say, okay, you can give us a security deposit of $3,000, or you can buy this security deposit insurance policy. Now you won't get the money back, but it's going to cost you $1,200 instead of $3,000.
I see.
Well, most people say, you know what, I'd rather pay $1,200 because in their mind, they're not going to be getting a lot of their security deposit back anyway.
Right. So, no, this is great. My next question is, but how does it help me as a landlord? Right. So I'm getting the premium. That's good. But let's say, they have let's talk about security deposit. I was supposed to get 3,000. They gave me only 1,200, and now damage worth more than 1,200. What happens to the 1,200 I had received at my insurance company will cover it, or should I also get reinsurance?
Well, reinsurance may not be available unless you have, we have people who have 60,000 apartments, 60,000 doors. They can get reinsurance.
I see.
But below a certain amount, it's not feasible. But that's where the actuary figures out, okay, with the lifetime of the apartments or homes that you have, how much have you had to go into the security deposit? What is the size of the average claim? Because most landlords will paint the walls, replace the carpets, do all the normal stuff that goes into it. This is just the extra damage on top of that. Right. But in analysis we've done, on the security deposit insurance side, if they're collecting $3,000, it's rare that the damage would be $10,000. If so, that gets into, criminal, and they did all this other stuff they shouldn't. But most of the time, it was, besides the paint and carpet, it's a $500 to $700 spend. So this becomes a profit center.
I see. And how would the tenant damage waiver work then?
So let's say that tenant does something. They let the bathtub run over. They burn the carpet because they put an iron on it. They did something like that. That now, if there's damage to the apartment, not their stuff inside of it, but the damage to the apartment, then you're still going to have your commercial insurance.
Okay.
That may, or like you said, most of the time it won't pay. So that $10,000. But if you got the tenant damage waiver on, over the years from many different tenants, then your insurance company would have the $10,000 to then, so you put yourself, it's indemnification. You want to put yourself in the same financial situation you were before the event happened.
Yes.
So now you have to spend $10,000 to fix it. And then you submit the claim to your insurance company, and your insurance company puts you back financially whole where you were before. And that's this is just one example with commercial property. But, many of our captives, we have health insurance, workers' comp. So health insurance keeps going up and up.
Yes.
Now, if you have, our clients with, call it 75 or 100 employees, should be looking at a captive to do their health insurance, because there's a way for them to save a lot of money. Then you say workers' comp. If they have a large enough people, let's say they're roofers, contractors, developers, home healthcare nurses, staffing. The list goes on and on and on. But we look at all the insurances for a business and say, what makes sense for them to keep in the market, because it's less expensive for them to give the risk to the traditional market. And then what is better for them to keep themselves. So if you'd been paying for $1 million general liability policy, and you've been paying that for 20 years and never had a claim, why wouldn't you put that inside your insurance company? So the way we got into this is we had our own insurance company, and we could write all different kinds. So I could actually write my own auto insurance. But I made the decision, why would I write $1 million auto insurance policy and take that risk to save $3,000 in the traditional market? So that's where it's one of those where you look at what is the cost, because if I had one claim in the next 40 years that was significant, I would wipe out all the underwriting, all the money in my insurance company I'd accumulated. So that you just have to look at all the insurances you have.
No, that's great. And I was listening very carefully because yes, now it's opening even my eyes even wider because I can go from tenant to general liability, E&O, right? Umbrella to pretty much everything I have, right? So this is great.
I mean, we have IT consulting companies
Yes,
go in
yeah,
and set up the security and protocols and stuff
yep,
for businesses. And they say, hey, you follow all of our stuff, we're actually going to give you a warranty from our insurance company. So in the event that, I mean, you have to follow all these steps, but it then becomes a marketing tool for some to say, look, we're going to give you this warranty. And then they take some of the money that came in as income and put it into warranties, or they say, would you like to buy a warranty?
yeah.
And if you buy that warranty, if anything, if you get a Trojan virus or something else, then we will come in and fix that for you. And you won't have to pay for it. It'll be paid for by the insurance company.
Right. No, that's great. So now my next question is, what would be the minimum premium for this to work, right? Does the premium have to be, because, and again, I'm just looking at my own example. I think on my IT consulting side, we pay between 10 to 15,000. Maybe if I combine tenant policies, another 10 grand. So what is the minimum if I want to create an insurance company? Would that be helpful from asset protection, tax benefits, and from everything else? Or do you suggest that it has to be this much before you even get involved?
Well, I would say our average premium is probably 800,000 a year.
Oh, okay.
But we have, because let's use your business. You have insurance in the traditional market, and that may be $15,000.
Yeah.
But your business has a ton of risk that you haven't purchased insurance for, that you just, you're going naked on.
Right.
Well, that's where the actuary comes in and figures out what are all the different premiums or what are all the different risks for all of your different businesses. And they're the ones that set the premium for you. But these can, depending on the structure, if you want a single parent insurance company, then you're probably talking $500,000 in premium a year in order to make it worthwhile. But there's other structures where you can go into, it's called series, like a series LLC.
Series LLC.
Yeah, you can go in. So there's a master insurance company, and then you just have your own insurance company underneath, and then that makes sense at 100,000, 200, but it's the actuary that's setting the risk, because then we have to go to the Department of Insurance to say, this is how much premium you should be doing. So our business is we design them, implement them, and manage them. That's it. So we don't manage money. We don't sell product. All we do is set up and run insurance companies for our clients. But
got it.
So let's use you as an example. Let's say that we sit down and we go through an analysis of all your different businesses, and the actuaries say, hey, you know what? We think you should be paying $200,000 in premium.
Okay.
And then you could pay the $200,000 in premium. You deduct it from your business. It goes into your own insurance company. That insurance company pays its taxes on realized investment earnings. And this just continues to go to grow. And then there's not a lot of good about living in California.
Tell me about it.
Yeah, exactly. But so one of my books is called "You Can Make It, But Can You Keep It?"
Yes, that is so important. I keep telling people that don't tell me that you make 300,000, 500,000. How much do you actually keep it, right? So,
Yeah.
and I love the book by, Tom Wheelwright, Tax-Free Wealth. And that opened again, all the avenues for me. And I always look at any investment I make, that am I going to have tax benefit from this investment? Even the Bitcoin mining we started because there is going to be humongous depreciation, right? Because I'm like, yeah, if I want to invest, I can just invest myself in cryptos. Why would I create large entity and do all this work? I got to see tax benefits, right? So that's so important.
I'd be interested to, not to go off topic, but your feeling on Chia, because I just started mining.
Oh, wow.
Mining Chia right now.
I
got
think
2 computers right out there that are.
Oh, nice. Yeah. So Chia, I think it's storage is a pretty important piece of the puzzle in crypto space, especially, we use centralized storage like Box, Dropbox, etc. So Shia, and there is another called Storj, Storj. I think they got good future, but things can change.
Yeah. But I had a couple extra computers and, some solid state hard drives. And I'm like, well, I've got extra space and, this
That's
is proof of
great.
space. So let's just do it.
Yeah, well, worth trying. So let me ask one more question about this. Let's say my revenue about $1 million, right? But my profit is $200,000, $300,000. In that case, is it worthwhile to put 200,000? Let's say that was the profit into an insurance company. Then that means I'm not gonna get paid anything as a W-2 employee of my business. And then how do I get that money out of the insurance company?
Yeah, well, I mean, if your profit is 200 and your revenue is $1 million, you probably, if you're probably living on the 200. But if you're not, then the actuary just comes up, and let's say the actuary came up and said, because of your business, you have $1 million in revenue, but the risk that you have that you've been just self-insuring is $100,000. Then you would put the $100,000 in as premium to your insurance company. And then your insurance company would invest in any of the assets. Now, there's a couple things you can do and a couple things you cannot do, okay? You can, the money can be invested in anything that doesn't, quote, threaten the financial solvency of the captive.
Oh, okay.
So anything that's fungible, liquid, that you could sell in order to pay a claim. Now, what you cannot do is you cannot loan the money back to the business that took the deduction.
Of course.
So let's say that, yeah, well, you'd be surprised.
Oh, really? Yeah, that's siphoning money.
Four tax court decisions went against the taxpayer, and 3 of the 4 had taken money out of the captive and loaned it back to the business.
Wow.
And that's where you shake your head. You're like, this should be common sense, but the saying goes, common sense isn't always common practice.
Nope.
But so you have the $100,000, it grows. You can then use it to invest in other stuff. You could actually, let's say you're going to go and buy a home or an investment property. Well, you can buy that in a limited partnership after the first year when it goes from reserves to excess. And then you can use money from the insurance company to invest in the real estate. It can buy membership interest or limited partnership interest. You can always take a dividend out of the captive insurance company, and dividends are taxed at they're taxed at long-term dividend rates.
Right.
Are lower than, as long as it's more than 12 months, are lower than ordinary income.
Okay.
So that's good. But like our insurance company, I don't need the money. I just need what the money can do for me. I need investments,
Right.
I need other stuff. So so I used it to provide a mortgage on a home that I wanted to buy. And now instead of paying Wells Fargo, I pay a monthly mortgage payment to my insurance company.
Yeah. So your insurance company is the note holder, right? So yeah. It's the bank. No, that's great.
The ultimate way to get out of it, let's say that you have tons of money in your insurance company, you sold your businesses and you don't need it. You can always give back your certificate of authority saying you're not going to be an insurance company anymore. And then you're now just a C Corp. So we go and get the name changed and restate the articles and file with the IRS that says, hey, we're no longer an insurance company. And now you're just a C Corp with millions of dollars in it. And then they got rid of the personal holding corp penalties. So you still just pay your 21% currently on realized investment earnings. So it's still really good. And I was going to say, this is where I got off track. One of the only good things about California is its community property. And people dislike community property for many reasons. But the one good thing is you get a full step up in basis at the first spouse's death.
Oh, nice.
So my wife knows the day after I die, she liquidates everything.
Yeah, no tax.
And then exactly. So then that way there will be no federal or state taxes on that. Now there'll be estate taxes on that, but that's why I have $22 million of life insurance and 6 different trusts and everything else. So, but at least we know, that to me, not that death is the ultimate exit strategy, but if you want to avoid taxes, income taxes, that's a good way to do it if you're in a community property state. But we have many clients that just give back their certificate. They now have a C Corp, and then they use that almost like their own personal bank, where they do investment deals, they do stocks, they do, that's why I do a lot of ETFs in those, because when the ETF buys and sells internally, you're not paying taxes on it. Any rebalancing. So.
Oh, that's great. So last question I have is, are there any gotchas while choosing captive insurance or while figuring this out?
Yeah, there are a lot of gotchas. They have to be done properly. The IRS has been amazingly consistent. They tell you what works and they tell you what doesn't work. And if you follow their rules, you're fine. But there's too many people out there that sold captives to businesses that don't have any risk. They just sold them as big, almost like Roth IRAs. They said, hey, we'll create an insurance company for you, and you put $2 million in it, $1 million, whatever, and it's going to grow. The premiums are tax-free, your underwriting profit is tax-free, and they just created these insurance companies really as tax dodges. So you need to make sure that the businesses that you're insuring have risk, and you need to file audited financial statements on them, on the insurance company every single year. That's what we do. Tax returns, statements of actuarial opinion. So there's stuff that goes into the running of the insurance company that's all done behind the scenes. You have to make sure you have somebody that does it good, and to me, most importantly, that your business has risk.
No, that's awesome. So let's take a quick break, and after the break, we'll go through the same questions I ask every guest.
Perfect.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing.
Welcome back to Wealth Matters podcast. Mr. Wesley shared a lot of golden nuggets today. I enjoyed the episode, and I hope all of you did. Are you ready for fire round?
Perfect. Bring it on, Alpesh.
Would you be changing any business or investment strategy after this pandemic is over?
Good question. I am waiting for the pandemic and the government assistance to end, and I'm watching it closely because I believe the stock market has been buoyed because of the excess money that people have, that they've been getting from the stock market. But when the pandemic ends and new money coming in stops, then I think there's going to be not just with stocks, but with real estate, for example, because right now lending rates are low. Without going really deep, lending rates are low because the baby boomers have been, their kids are out of the house. So they've been flooding money into banks, and the banks have all of this money. So we've had a really low interest rate for a long time. But between 22 and 24, those baby boomers, a lot of them will be retired, and new money into the system, new money into the 401ks, new money into the CDs, all of that will dry up. So I believe you're going to see mortgage rates go. They'll have to go to anywhere between 6.5% and 8%. And if I'm wrong, I'd love to be wrong, but I think the stock market will go down because new money into it. There'll always be, really good companies to invest in. But as a whole, I think right now they're maximizing their retirement. And that will end at some point. So I'm closely watching it, but I really believe that 2022 and 2024, you'll see a correction in the stock market and the real estate market.
I agree.
Then that's the buying time. Keep your powder dry and go in and buy.
When there is blood on the street, right? You got to get in.
Correct.
Favorite real estate or finance or any other related book?
Ooh, you know what? I just read a book that I thought two people had recommended it to me, and I'd never heard of it. and it was written in the early 2000s by a guy named Felix Dennis.
Well,
You ever heard of him?
No.
He's the guy who started Maxim magazine. And
Oh,
he's a
really?
publishing guy, but it's
Ah.
called How to Be Rich.
Oh, okay. I have not
But
heard of it.
Two people told me about the book, so I bought it and read it. And I got to tell you, I was fascinated. And it talks about real estate deals he did. It talks about, but a lot of the book was the mistakes he made
Yes.
along the way to keep you out of it, and then, you probably heard a lot of people telling you, but Principles by Ray Dalio. I think it's one of the best books, Random Walk on Wall Street. A lot of those books are good, but I really enjoyed How to Be Rich because because a lot of these business books are fluff, where they don't give you, they'll tell you, oh, I did this great and I did this great and I did this great. He actually says, look, this is when I was almost bankrupt. This is when I had to borrow from this bank, to deposit a check in this because it was a 2-day float. I mean, he's telling you all the bad parts about running a business. So, if there's a lot of people out there that are struggling now, and I think it gives them a good perspective.
No, that's great. I'm going to check that out as well. So the other question I have on the fire round, any tool or website you recommend?
As I think
maybe in your investment or in your basically insurance side.
Yeah. So, I mean, my ETFs are pretty automated. I mean, it's all done with AI, and the AI continues to get smarter on itself. So it's true AI. But I'm just thinking about the tools I use every day. I use Otter a lot. Otter.ai.
Yes, Otter.ai. Yep, I do
all
too.
of my meetings, just to make sure I have everything done. And then Zoom.
Yes.
We
are on Zoom now.
Yeah. But I mean, one thing that I did do is, and I recommend people to do it, is to go get their own name on Zoom. So you have Zoom with, go get the domain name, Zoom with Alpesh, Zoom with
okay, that's a good idea.
Zoom with Wes, Zoom with John S. I mean, do it. And then that way they don't have to, the people don't have to type in the stuff all the time. They can just go to that one site. And then I also through Calendly have talk with.
Yes.
So I tell everyone, hey, just to me, you want to make it as easy and user-friendly for people to find you. So
that's a great advice. Any advice for beginner investors?
I mean, I would say don't think you're smarter than you are, because too often you'll have an early win and then you think, oh, you have this whole thing nailed. And to me, winning in the stock market, it's you can make it, but can you keep it? To me, the key that the stock market goes up, but the key is, it's not losing.
Yes.
And that's where people, so if you were in the S&P 500 from December 1st, 1996 to December 1st, 2019, you would have done 8.1 times your money. If you were smart enough to, even after the market went down 10%, to go on the sidelines and wait till it goes back up 10%, you would have far more wealth, and that's where, I'm basically like a researcher. So I try to find all these tricks. But if you want to go in the S&P 500, great. If I'm a beginner investor, I would go into the S&P low vol 50. So it's the 50 lowest volatility stocks of the S&P 500, because even in bad times, those are the ones to me that are making money. It's the Amazons of the world. If you look at the S&P 500 10 years ago and see how many of those companies are still in the S&P 500. Kodak wasn't. They're not in it anymore. So to me, it's the lowest volatility, highest profit stocks. I think you're on mute.
That's great. How do you give back?
How do I give back? Well, we have our own foundation. My wife and I do, the Sierk Foundation. So the Sierk Family Foundation. So we, in our town, I mean, not to brag, but in our town, the Little League field is called the Sierk Family Foundation field. We give a lot to soldiers, PTSD, companion dogs for returning soldiers. So I find we give to kids charities and schools, and we give to soldiers, because these are the people that sacrifice their life so we can live in this great country. But
that's awesome.
I believe in foundations. Foundations are great. And if you haven't had somebody come on and talk about foundations, definitely something that's worth doing. And there's huge tax benefits.
Yes.
I don't know if you've ever had anyone come talk about charitable LLCs.
No, I have not, but
Right.
a lot of people have mentioned it to me. So I'm looking into those actually.
Yeah. So we created our own charitable LLC.
Nice.
And, with the donor advised fund and everything else. So the K1s go to the charities, and
Yep.
we have to give out 20 to 25% what we save in taxes every single year to meet the rules. But if you do it right, it's great. And I didn't come up with the idea.
Yes.
It's the same thing Bill and Melinda Gates did when he had all of his Microsoft
Exactly.
stock,
Yeah.
put it in his foundation, and then
Huge. Yeah. And in the end, they are doing good for the community, right? So, I believe it's a win-win you are creating, right? So
yeah, correct. Yep.
No, this is great. Thank you so much for your time. How can my listeners reach out to you?
We're on all of the social channels. It's Wesley Sierk, for Instagram and YouTube. YouTube, we have an RMA captive. Our company's Risk Management Advisors. We have an RMA captive channel where we're always putting up. I put up 2 videos yesterday about things to look out. What are the good things? What are the bad things? Our company's Risk Management Advisors. So it's Risk, RISK, MGMT, and then Advisors, ADVISORS. And we have a lot of information on there, and, click-throughs to talk to me if they have questions, and, always love to help your listeners. Yeah. I kind of got hooked on your Wealth Matters podcast. So I've been binging it.
Oh, that's awesome.
Great.
Thank you so much for doing that. And
Really good information.
I thoroughly enjoyed our discussion today. Thanks again.
Oh, thank you.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!